one thing about pattern recognitions that you have as an investor that you don't have as an entrepreneur is, there is a cycle. And sometimes I describe it as a dance, but there's a cycle in terms of milestones you need to reach over a certain amount of time, when you need to start raising money. And I found very often entrepreneurs are just missing that. And this is what getting them into troubles. I'm trying to make sure that they think about their long-term plan. I always say it's a chess game. What matters is winning in the end. It's not just the next move that matters. So you need to think a number of moves ahead, and you need to start preparing your business for the next investors. What is the next investors want to see? What milestones you need to reach? Eventually, you're going to have to start preparing your company for growth investors and eventually for an exit.
Hey, everyone. Welcome back to the Ignite podcast. Today, we're thrilled to have Ian Sosso on the program. He's an award-winning founder, managing partner of Monte Carlo Capital. Yes, that's in Monte Carlo. Ian has built an impressive venture firm, mixing both angel and venture investing. He started investing his own angel capital, as one does, eventually running over 50 syndicates. I'd love to dig into that number, because that's exactly how many syndicates I ran before I started my own fund. With a unique approach to investing in venture, leveraging his network and experience he built as an investment banker and his reach in the European ecosystem. Thanks for coming on, Ian.
Thanks for having me.
So tell us your origin story. How did you end up down there in the south of France? What inspired you to work in finance and eventually transition into venture capital?
Sure. Actually, it started in the south of France for me. Actually, I grew up in Monaco. I'm one of the 9,000 citizens of the Principality of Monaco. But I was educated in the UK, went to study there, and I went straight into investment banking. I worked on trading floors, London, Tokyo, Hong Kong, Singapore, back to London. And I worked for big banks, like JP Morgan, UBS, HSBC. When I was 33, Commerzbank, which is the second largest German bank, asked me to build their derivatives business in Asia out of Hong Kong, which I did. And I pretty quickly became the head of the overall investment bank in Asia out of Hong Kong. So that's what my investment banking journey. And I stopped working about 15 years ago in banking. I started Monte Carlo Capital, which is initially just to invest my own money. So although I run essentially all the public markets, I always invest in my own money in private markets on the basis that if I can source my deals and structure them and influence them all the way to exit, I would generate substantially higher returns than investing in the public markets, although this was my job. So when I stopped working, I decided just to focus entirely on what I enjoyed, and that's what was generating substantially higher returns, which was early stage venture.
That's really interesting. So you started in kind of the public markets, investment banking, traveling around the world, lots of interesting places. And then at some point along the way, you kind of got exposed to this alternative asset class that is venture capital. Tell us about kind of that first exposure, maybe what that aha moment was for you, like, oh, this is an interesting asset class where I can generate outsized returns.
So I started, I think like a lot of people probably here or who are not in the right ecosystem, basically investing probably 20 years ago, maybe more than that now, in friends showing you deals. Everything looks cool when you're investing in tech. Starting to make a couple of investments, and then things go south, and I just realized that maybe I don't really understand how that works. And as I started just manage my own money independently out of Monte Carlo Capital, I would spend a lot of time drilling into the angel worlds, how that worked, and I came to a number of conclusions. It's at the very early stage that value is being created as an investor. So I think that the greatest returns are generated at the very early stage. But at the same time, it's a very hard sector, a very hard stage to invest in, right? You have little data and so on. And the angel suffer from, I think, a lot of challenges. I mean, you're based probably in the best ecosystem on the planet to do that. But people who are not there, I think, suffer from significant headwinds. They don't have the deal flows, the scope, the scale, and is making their activity as an angel investor essentially challenging. The other thing I found was that CEOs, founders spend most of their time raising money. The angel and the venture model is based around different groups leading different stages. So you have the angels, pre-seed, the seed, and so on. And every time you typically have a different lead. And although I see the benefit of it, I also some of the challenges, which were essentially you were at the mercy of the next round of investors. And then along the way you have crisis, pandemics, and all those things, bad things that can happen. So I thought it was a risk I started essentially to build a strategy looking to mitigate those risks. That's where my strategy has evolved as a fund manager now, and I'll tell you more about it. But initially, that was my take. And I would, come in very early, very often as a first ticket, and I would do a lot of due diligence, and I would typically take an entire financing. So $500,000 to $1.5 million, myself and the syndicates. My investors are all private investors, typically a lot of entrepreneurs, a few family offices, people come from the financial industry, hedge fund managers, investment bankers. This is where I'm coming from. And we'll take an entire financing. So let's say $500,000 to $1.5 million as a first ticket. I would be very involved in the business. I think a lot more than usually investors are. I've traveled 3 continents with one of our portfolio companies. I would bring in directors, chairman, clients. I would get very involved. And if things were sort of going according to plan, I would essentially lead multiple rounds, which is, again, pretty unusual. So I've led up to 5 financings in a row. I would say to a sort of early B from the first rounds. We've put up to $7-8 million in the same company over multiple rounds. And that's basically the way it's been working. You ask about the 50 syndicates. So that was in only 23 companies. So 50 round, 23 companies. So one of the consequences of the way we've been working is that we build pretty concentrated portfolio, but big positions in the winners. I mean, assuming that you can actually pick the winners and you can build those positions. And today, our biggest positions are in sort of the winners. So we build substantial positions. So we still own, 20, 25, sometimes close to 30% of companies that are sort of Series B level companies as a consequence of the way we've been working.
Yeah, I mean, that's pretty substantial. And that multi-stage syndicate, early mid-stage strategy is pretty unique. And most of the time, if you're an angel, you're kind of doing the friends and family round or the angel round, writing a little 25, 50K check, something like that. And then maybe you help make some intros later. But very rarely do you lead a financing as an angel or a syndicate lead and then do it in multi-rounds. So it's a pretty unique strategy.
It has a lot of benefits. The fact that you are very involved, very hands-on, you actually do have an influence, but it's also the shortcoming of it, right? Which essentially a lot of things depend on you. If you are the main source of finance, the company relies on you quite a bit, and you end up being quite concentrated, and it's also not very scalable. I mean, there's a certain amount of companies you can be that engaged in scale, which therefore led to the creation of the funds and an adjustment to the strategy that is more in line with what typically I would say SPVs we do, allowing more scaling, more diversification, and so on.
I guess this is a question, but to what degree was that method of investing it emerged from the realities of the ecosystem in which you found yourself?
Yeah, I think it's a good point, right? So I think that if you're starting very early and you're not in an ecosystem that is as developed as you may have in the Valley or in Cambridge or in NYC, in Boston, I mean, the big ecosystem, somehow I think you have to take quite a bit on yourself and deal with and solve for the limitation of your own ecosystem by being very involved and very hands-on. And I guess this is to some degree what we've been doing. I mean, the strategy of the fund has evolved. Now that we have a fund, so the strategy has evolved where we are probably a lot more standard. So we're coming at seed, which is later than where we've been coming in initially. Typically, party rounds where we are co-investing with other investors. So we've been investing with some amazing investors and VCs along the way, which essentially is allowing us to share resources, access. We're not leading, we're co-investing, although we're still, I would say, very hands-on for a co-investor. And to be honest, this is also the area I enjoy the most personally, is just by helping the companies. This is the most fun part of the job, but not taking it on everything on my own, which is allowing us essentially to be a lot more diversified, to be actually making a lot more investments in a year, and so on and so forth.
Yeah. And so you're doing this angel/syndicate multi-round strategy. And at what point did you decide to raise your first fund?
I started investing really actively, probably maybe 15 years ago, increasingly. And then probably 8 years ago, I decided to make a business out of that. So this is when I started to organize a lot of syndicates and becoming a full-time angel investor, really. But then it's a crazy amount of work. And there is a limitation to how much I can do on my own. I was essentially working on my own. And I saw that I need more resources. I mean, I need more diversification. If you are that concentrated, if there's a crisis somewhere, you feel it nearly as much as the entrepreneur, which means that you're spending your life essentially extinguishing fires and being super stressed out. And I thought I need something that is more diversified, for myself as a private investor. I really build a strategy for myself as a private investor to start with. And then people in my syndicates also, I thought essentially they would want more diversification, being able to sleep a bit better at night as well by being a lot more diversified and investing slightly later. So this is when I decided that I would need to carry on investing through a fund, and which allowing me essentially to have a small team. So it's a very small fund, which means I essentially carry on paying most of the running costs myself, but essentially is allowing me a platform to do a lot more things. And I think it's made a big difference in terms of the next stage of what we've been doing. Interestingly enough, because our DNA is very much that of a direct investor that likes to be hands-on, we actually invest a lot more through a syndicate. So we have sort of a hybrid model where we have a small fund. We do tickets through the fund, which, we've done $5, $6, $7 million direct investment in the past. So we're actually building our positions through SPVs on the side, which is working out just very well. So we have very small funds and a lot of the flexibility with the SPVs, which my investors actually really like. Which we like as well. It's giving us a lot more flexibility. So I think it's a good model. I'm going to carry on building on that.
Yeah. How do you think about the push and pull between diversification and concentration?
Yeah, you can probably draw a chart, right? The ultimate alpha, the ultimate concentration is being an entrepreneur. You're all in one business. And if it works out, you're doing extremely well. If it doesn't work out, it's different. And you need to find the right balance. I'm not sure there's actually any conclusive data, right? There seems to be so many different ways to skin the cat depending on what your own preference is and your own experiences. You see on one hand, investors that build a portfolio with 100 positions inside, which is one strategy. You see people actually very concentrated, which was my case until now, which actually I enjoyed a lot. The very strong involvement with the businesses was extremely rewarding, informative, and I really enjoyed it. But as a fund manager, suddenly my responsibility changes. I know I have to create a fund that has high performance, diversified, and so on. So for me, I'm putting my sweet spots in the first fund we have at 30 companies, right? So it's about 10 investments a year, which I think is diversified enough that we should be able to generate the right returns with reasonably, I think we can have a high degree of confidence we're going to be able to generate good returns given the diversification we have.
Your pedigree over the last 15 years has been going really deep with a small number, and now you're not going to take that 20 multi-stage angel syndicate strategy and blow it up to 100. So I think 30 probably makes sense for the way that you guys like to invest. How did you think about building the team? What were those first kind of roles that you looked to hire?
Essentially, we have a full-time analyst. We have interns that are rotating. Typically they have MBA kind of profile, helping with a million things. As you know, when you're running such a small shop, there's so much to do across so many different areas. Essentially, it's helping with the filtering of the first company, typically having a first call with the companies. And if it's a warm introduction, I would typically have the first call. There's a million things to do on the back of that. We have interns, also sort of MBA profiles changing every 6 months. And then we have somebody doing admin. There's a lot of cash flows following, just essentially basic admin for us. And it's good enough. For what we're doing is good enough. We probably can do, I would say, 50% more, or maybe even 100% more in terms of volume with what we have. And I think if we were to do more, then we will have to add a few more bodies.
Yeah. If you doubled in size, what would be the next role you would hire?
Maybe another analyst, maybe a bit more senior as well, depending on the size what we're doing. But the SPVs are quite time consuming as well. We do very detailed memos. We interview the CEOs. We probably need a bit more resources on that front as well. But we're probably investing, I would say, $7-8 million a year. As a solo GP with a small team, I think my sweet spot probably would be about $15 million a year, which is what I want to build to. Big enough that it makes sense for me as an investor. All the time I'm spending on it, enough resources to pay a small team, big enough to be an attractive investor and small enough to still be able to generate the returns that you want to generate when you invest at that kind of stage.
How do you think about the decision to run an SPV if you're already investing from the fund? This is something I struggle with myself. Having this large syndicate, Team Ignite historically was a syndicate. We have the funds, obviously, that we invest from. We do run sidecars from time to time. Usually the way I phrase it is I tell the founder, like, hey, I'm happy to run the syndicate. You can get more people on your cap table, have a roll-up vehicle, get more people interested, raise more capital, things like that. But I find, especially over the last year and a half to 2 years, SPVs have been pretty soft. So I kind of set expectations low with the founders. But how do you think about running that SPV versus I wrote the $400,000 check from the fund. Why run the syndicate at all?
Yeah. So I think running both at the same time has made a lot of difference for us. First of all, the fund. I think putting together a syndicate takes time. I think not everybody manages to put a syndicate together. So I think you're a company, you probably have to think twice about speaking to a syndicate if you really want to close something fast and you have a lot of choices. So we've never failed to raise the money we wanted to raise for a syndicate. But, as a founder, you would only know that post-experience, not. So that's the first thing. I think very importantly, because we are now investing at seed and there always are very good funds when we're investing, compared to an angel, we're sharing deals regularly a lot with other funds.
Right,
this is a major part of the deal flow is other funds.
Yeah,
and
it's kind of our secret sauce in early stage, right? We're all sharing deals because most none of us in pre-seed are taking the whole round.
So historically, because we were taking an entire round and we were the first investors, I basically wouldn't have that luxury. So I would go out and decide for myself whether I want to do it or not. Now we're sharing deals with other funds, and it's a lot easier to convince for a fund, I think, to share a deal with another fund because they know you can commit. So a combination allows me to do is the following. I can actually secure my spot with a fund. So, you know what? I'm interested in investing. We'll do 350K tickets. Give us 4 weeks from now to the day we wrap it up, the SPV up, to do an SPV. I can't tell you exactly how much we end up with, but the range is 400K to $1 million, right? I've never failed to raise the money. We'll go through a process. Give us a week. We'll have an interview like you're doing now. We write a memo that you will review. We'll give our investors 2 weeks to decide whether they want to invest or not. Typically, we'll also do a webinar. Increasingly, we're also organizing in-person events in Monaco. So the founder will be on the webinar. And there's 2 weeks for people to decide and then about a week for people to wrap it up for the paperwork. We've never lost a deal on that basis. Every single investment we made, even when the rounds were full, the founders were okay to wait for us because we could actually underwrite the deal. We said, well, way in any ways through the fund. So having the fund really helped us a lot, becoming a seed investor and co-investing with some of the best seed funds around who are sharing now deals with us. The fact is, all my investors love direct deals. So I'm opening a bracket here because I don't think it's something you would be aware of if you're based in the US. Most of the money in venture in Europe has public money. Most of the venture funds have got public money, one way or the other, which comes with a lot of strings attached. Very little amounts. Don't invest much in the US, don't invest much in the UK, not too much in Switzerland. You have to focus on the European Union. It comes with a lot of strings attached in terms of what you can do and can't do. We only have private investors, which gives us a lot of flexibility. A lot of the public money also, by the way, doesn't like SPVs. So we have the freedom to be able to do a lot of investment. That's why 60-70% of what we do is in the US. We invest in quite a lot in Switzerland. We do quite a bit in the UK. And we do a lot of SPVs because our investors just love doing SPVs. So the SPVs give us a lot of flexibility. If you think about building a $5, $6, $7 million position when you're a seed investor, you need to have a very specific strategy around that. You need to have a much larger fund. You don't know how many of the winners you're going to have, how many companies you want to have $5, $6, $7 million into. And as you know, much bigger funds tend at some point to reach a threshold after which the performance starts to not be as great as if you have a very small fund. We have a bit of a we are sort of having our cake and eating it to some degree. We have a very small funds, which gives us flexibility to invest in, to be very nimble. I'm a solo GP. And as you know, these very small funds tend to have very strong performance. But it's also giving us a firepower to be able to carry on investing in our winners at the discretion of our investors, much more substantial amounts. Although, of course, it's more work having an SPV, and it's a lot more work.
Yeah.
In the end, it's giving us a flexibility that is working for us, and I think is working for investors as well. I kind of like that model. I also enjoy, to be honest, personally, the interaction with our investors. I mean, the fact that I have to promote and share a lot of information with our investors on a particular opportunity. I mean, we need to make sure that we're really sizing that opportunity and we are getting our head around it. So 10, 12 pages, memos, interviews, data rooms. We need to be able to explain very clearly why we're investing in a company, to be able to convince people who are typically very smart people to come in. I think it just also gives us a lot of discipline in the way we do that. So I think it's just... I like it.
Have you considered maybe having a second fund that invests in follow-ons, like an opportunity fund?
Not so far. I think what we'll do essentially is, launch a second fund. So the first fund, we're closing our 17th investment right now. We have a hard close in a few weeks, I think in January, end of January for the first fund. And then we'll have a second fund in 26, looking to raise a bit more, but with the same strategy. Essentially. And I think, once we reach, I think, the level where we're investing about $50 million per annum, both via the fund and SPVs, I think that would be my sweet spot. And I think we'll probably leave it at that. So
in the second fund, do you think with the bigger fund, you'll just reserve more capital for follow-ons?
I think for the second fund, we'll probably do a slightly larger size tickets from the fund as a first ticket. We may do, as opposed to doing 30 tickets, we may do 35 tickets. And we will have a bit more reserves, and that's really it. Yeah. And then we'll carry on doing the SPVs on the side. And the SPV typically is the way I choose to do an SPV or not. I think it's just depending on circumstances. If you're doing a YC investments, I mean, we're going through YC deals right now. Obviously, it's a turnaround time. It's so quick that, you can't. I don't want also to run two SPVs at the same time. I think it's just very hard to raise money at two SPVs at the same time. So whenever we have the time to do it, which is really about a month, let's say 5 weeks, we do an SPV. So, I'm looking to launch 6-7 SPVs a year. I think that's basically the plan. And I think we can doing that on an ongoing basis.
Yeah, makes sense. What was the thinking to base yourself down in Monaco? Is it just as simple as that? That's where you're from and where you want to live, or was there any kind of reason for it?
I mean, after I finished working in banking in Hong Kong, I decided to stop working once and for all, and I moved to Bali with my wife in the south of in Indonesia, where we have a house. And I thought I'd be working 2 hours a day, and I'm done. Fortunately, I realized with great despair, I missed work a lot, and starting to do one deal and two deals, and eventually wanted to build a business out of that. So, wearing flip-flops in Bali and working from your swimming pool wasn't necessarily the best way to build a business. So I had to find a place to be. And I love living in Monaco. I think it's such an amazing place. And because we're investing so internationally, really where we're based is not as important. Also separately, because all our investors are private investors and some families, I mean, just Monaco is a great place to do that, and it's very easy to travel from, and it's a great place to live as well. So I think it's just a great base for me.
Yeah, that makes sense. So switching gears to evaluating companies, we talked a lot about fund mechanics, where deal flow comes from, how you structure deals, funds, SPVs. One question I didn't actually ask that I wanted to know from a European perspective is, where do you run your SPVs? Do you use a back office fund admin for that?
I mean, it's been a very big topic for a very long time, where the US probably has the most cost-efficient ecosystem to run funds and SPVs, and it was really lagging in Europe. There are now fintech that are running in very similar models to what we have in the US that offer very cost-efficient funds and very cost-efficient SPV structures. So essentially, we will have the same platform. Essentially, the fintech we've been working with have been bought by Carta. So now it is part of Carta. And they are essentially offering us both the fund and the SPV. So the fund is a Luxembourg fund, which surprisingly is extremely cost effective. And the SPVs are UK LLPs, limited liability partnerships, which are cost transparent, very cost efficient as well, very easy to run now. So I think there's been a development over the last few years in Europe. And I think actually we fuel quite substantially the growth in very early stage investing in Europe as well. I think it's really a game changer, having the ability to do that easily.
Yeah. Is there a particular platform? I know there's like Odin over there that I've seen. And here we have like obviously AngelList and Sidecar and Carta and Decile and a bunch of others. But is there a platform in Europe that you like more? You invest internationally.
So we're using Carta in Europe. So the company that we started working with was called Vauban, VAUBAN, based in London. They were purchased by Carta maybe 2 years ago, and they are being used actively by people who do similar things to what I do. Whether it's on the fund side.
And that one has a much lower cost, as I recall, right? I think Carta is like 10K to run an SPV in the US.
It's not far off in Europe. I think it depends. It depends on the few bells and whistles that you may want to have on your SPV, but it's around that, and it's super cost effective. Super.
Yeah. Switching gears to investment philosophy, you've been doing this now for 15 years. What qualities are you looking for in the team and the startup that you're investing in?
I really started this to invest my own money, and I wanted an investment strategy that I think is sustainable over the long term. Now, I think one of the learnings that I've had working in the financial industry for so many years is that, you've got cycles. And in the financial industry, different sectors, you got the boom and the bust. And what's very striking to me in the tech industry and the venture industry is that these boom and bust are even more regular. So the tech industry becomes enamored with a particular industry every 18 to 24 months. Everybody invests in it. It's a lot easier to raise money. And then you have a significant corrections. And then the tech industry gets in love with another industry. And it goes on and on. And I really wanted to stay away from that as much as possible. So A is avoiding fads, I think, as the first thing. The second thing is I think it's a lot easier to build a business if you're really addressing a real pain point, no matter what the industry is. So, and I think it's a strategy that is sustainable, over my lifetime. So in the end, we end up investing with two very strong themes that I really just want. A, investing in businesses addressing real problems through technology. So deep tech-ish, not too DP, but still quite deep tech. So anything
not bare metal tech, but
correct.
Platform layers, things like that. Yeah.
So we do anything from anything quite a bit of AI, industrial IoT, medical device, space, and so on. The other half is addressing big inefficiencies, right? So looking at a market that is maybe old schools, but is big and is ripe for disruptions. So there we've done anything from energy distribution to fintech, marketplaces, and so on. So we have very strong theme, but it's sector agnostic, if that makes sense. So one benefit of that is that we're actually pretty diversified in terms of sectors, although the themes remain strong, which, all our businesses have these features. We are quite diversified across sectors, which I found pretty good position to be in, particularly when you had COVID and then you had the war and you have, very unstable environments.
Well, and you have these fads too, right? It's the same reason I didn't do an AI focused fund, even though I came from AI, is I knew it was catching fire and it was kind of we were in the boom cycle over the last couple of years in AI. And I just knew that I'm going to end up like, somebody who deployed all my capital in 2021. If I do that, I'm just going to be chasing very, very high valuations, very competitive rounds, and there'll be a big fallout afterwards.
I think AI, it's interesting. The question I usually ask myself, is it a fad? Is it real? And I do think AI, actually, it's a turning point. But then again, you have to keep your heads on and just approach those firms the same way as you approach other firms. Are you solving a big problem? Can you build a moat? And so on and so forth, right? But we invest quite a bit in AI.
Yeah, us too. But I wanted to, I agree with your perspective, which is sector agnostic and kind of looking across industries and trying to figure out what's ripe for disruption, what's transformative, what's another way I characterize this as timing. Why is it the right time for this business? Some are too late to the party, some are too early, and some are just right. Goldilocks, right in the middle. What else do you consider as you're looking at all the different startups you could be investing. You're only doing 10 a year, right? So, it's
So,
about one a month.
I mean, I think the idea is very simple. Does it address a big problem better than anything else in the world? Or is it addressing a big inefficiencies better than anything else, right? Second thing, is the TAM big enough? Can we generate significant venture type of returns by doing that? And in that respect, by the way, opening a bracket, being in Europe, there are companies that are investing in the US. I wouldn't be investing in Europe. So Europe is reasonably fragmented. So if I'm looking at something in Europe that is addressing a local market, the size of the market opportunity needs to be significant in a geography that is European size of geography, right? As opposed to the US. So typically I would want to invest in businesses that could be anywhere. So they're addressing a pan-European, they can become pan-European quite easily, or they can become global by their nature. So the US, given the size of the internal markets, this is typically not a question I'm asking myself, or whether the internal market typically is big enough that you're not going to be limited. So I think this is something I'm really considering when I'm investing in Europe or not. Is this something that can become very big despite being somehow in Europe? So we have 3 investments in Switzerland, for example, from the fund, which is, a small economy, particularly compared to the US, but it's the investment we've made have those features where they could become very large despite being based in a small market. So I think it's something you have to keep in mind when investing in Europe. So very, very large opportunity. And of course, the team is everything in the end. And this is what everybody's telling you. And when you're reading and you're starting to learn about venture, the team is always center points. But I think the more you're doing these things, the more of the time you realize it is in the end, the results come from the team. And same company with a great team on an average team will have completely different outcome. And of course, this is the hardest thing to judge. Of course, you're seed entrepreneurs, done it 5 times before, and it's just, de-risk substantially, but then finding those companies at the right price and so on and so forth is not obvious as well. So it is the hardest thing, is a soft part of it. And, very often in the end, the reason why we don't invest is just that part, is loves the idea, loves the business, loves the technology, loves the market. I don't think these guys can make it. And this is usually why, we eventually don't invest in a company, essentially is based on that.
You just don't think it'll be venture scalable?
I don't know. I think it may be venture scalable. I don't think the team will be able to deliver. I don't think they have the experience or what it takes to build a big business.
Yeah.
And how do you determine that? I mean, it's a soft skill.
It's a soft skill. It really is. Yeah.
And in the end, it's the hardest thing is to determine whether they're the right people or not, right?
Right. It's kind of a privileged position we occupy as VCs because we see so much deal flow over the years. Any given month, I'm looking at hundreds of deals, and you start seeing the same thing with different teams and different flavors, right? And so you start getting a little bit of that soft skill pattern recognition. I just saw a team. You talked about YC. I was just at demo day as we record this, yesterday, and you just see a lot of amazing teams there tackling the problem. And then you run into other teams. Sometimes they're even better than YC. Sometimes they're not. And so you're trying to think about who's going to win here and why now. And that's really a soft skill.
It is hard. And this is why you need to be diversified when you're building a strategy, because in the end, you're going to get some right. Sometimes you're going to get it wrong. I think it's just very hard to determine. So pattern recognition is important. I think it can also be a challenge. So the more you've been doing these things, the more experience you've got, but you also are at the mercy of your own experience. You'll have some preferences for certain type of profiles because maybe they're more like you. Maybe you've had some success in the past with a particular profile, and you'll think this is the best profile to invest in. But if you look over the years, the different profiles have had some success, right? So sometimes the pattern recognition helps, and I think on balance, it does help. And that's what the experience is about. But sometimes it can also hinder you from taking a step in the unknown and into something that may be successful.
I think there's some sort of U-shape, I think. This happens in music as well. You look at an artist's career, they have a good 10 to 20 year run where they're just really good at creating music. It's very unusual that a musician can create amazing top-notch music for multiple decades. You kind of have this, and maybe there's the same phenomenon as an investor. You have this ramp up, that first 5-year kind of ramp up, the first 50 investments, let's call it, those first 50 syndicates. You learn a lot, And then you have this 10 to 20 year run of being really, really good at making investments. And then maybe your skills go stale. There's some psychological, intellectual mechanism there where maybe you get too old for it, or maybe you just kind of, you're spoiled, right? You've seen everything. You don't think anything's going to work anymore. And you're like, these kids don't know what they're talking about. Get off my lawn.
You know what? I think it's very possible. You need a certain amount of naivety to start a business. If you think about everything that can go wrong and the consequences you will have in your life, maybe you're not going to start a business. So you need a fair amount of optimism and naivety to be able to start a business and eventually be successful. And you need to have that to be able to make the jump and see something that is different. So it's possible that once you've done that for too long, you become a bit jaded about things and you may be missing opportunity. But yeah, I don't know, for a while. Hopefully the edge will stick around for a lot longer.
Yeah, I tend to be an optimist, so hopefully that will carry through to my old age, and I'll be, down the middle, not too optimistic, not too pessimistic. But so, post check, how are you adding value for founders as they kind of start to scale and grow?
Yeah. So I think there's again a pre-fund and post-fund. So pre-fund, essentially I would get very involved. So involved as in really helping out. So anything from sometimes helping design pitch decks, or rather telling the equity story. I brought in chairman, directors, some companies I brought in people in my group, biggest clients sometimes. As businesses grow, it's really help with the strategy. One thing about pattern recognitions that you have as an investor that you don't have as an entrepreneur is, there is a cycle. Sometimes I describe it as a dance, but there's a cycle in terms of milestones you need to reach over a certain amount of time when you need to start raising money. And I found very often entrepreneurs are just missing that. And this is what getting them into trouble. So I'm trying to make sure that they think about their long-term plan. I always say it's a chess game. What matters is winning in the end. It's not just the next move that matters. Yeah. So you need to think a number of moves ahead, and you need to start preparing your business for the next investors. What is the next investors want to see? What milestones you need to reach? Eventually, you're going to have to start preparing your company for growth investors and eventually for an exit. We have a company that we are the main investors in. One of my investors is a very experienced investment banker. He brought in debt during the crisis, sort of the COVID crisis. He brought in debt from a bank. That made such a big difference. Now we are helping that particular company find advisors, the right advisors, not just the banks, but the people inside which bank to speak to prepare the company for an exit. So it's helping as much as possible along the way. Now that we are sort of moving away from being super engaged because it's unscalable to becoming an added value co-investor, I'm helping wherever I can. Somehow, and that's a question sometimes being asked, how do you win deals in the US? It's such a big market, particularly in the Valley. And I think it's a fair question. I didn't mention that, but I'm very engaged in the ecosystem in Europe. So the angel networks in Europe typically get federated at the country level with a sort of a mother organization of angels in the country. And then these angels get federated in Brussels by a European-wide organization called EBAN, which stands for European Business Angel Networks. It's like the ACA in the US, essentially. So I'm on the board of the main organization in Brussels. I won an award as the best angel investor in Europe at that point. So essentially, I get to, through EBAN, we get a network that is pan-European and it's very broad. Plus the fact that I spent 16 years as an investment banker in Asia, and I do also have a network in the Middle East. Right. When we come into a company that may be based in a valley, our marginal added value is quite substantial compared to a company getting yet another valley investor. The convenience of having somebody in the valley, the network, I think, is great. But that particular new investor may have an ecosystem that is not very different from the other ones. Whereas our ecosystem is very different and is very broad as well. And essentially is allowing us to win deals. And I think being a particularly attractive investor. And back to one thing I was saying earlier, which is it's unusual for a fund not to have public money. We're actually investing a lot in the US, so I'm very comfortable investing in the US. So all this input together means that, I think we are able to add quite a bit of value depending on what our investors need. Now, of course, depending on the sector, we may or not be able to add more. But imagine a US company wanted to come to Europe. I mean, just, or even to Asia. I mean, I
Yeah.
can open doors very easily,
Yeah.
pretty much no matter where they want to set up or where they want to go, at least guide them. I'm not building their business, but at least
Right.
guide them. I can very easily
Yeah.
do that.
Let's switch to some quick questions to wrap it up. Rapid fire. What's your favorite deep tech innovation or startup you've invested in?
So we invested in so many cool companies, but maybe I'll pick two that we have from the fund right now, although it feels unfair to the other ones. But there's one company we invested in, and we're actually adding some money from the fund right now, through an SPV, closing it in the next few weeks, called Auriga Space, based in Los Angeles. So they went through the accelerator of Seraphim, which is probably the biggest space fund in the world now. And they have an accelerator. And Auriga essentially is looking to completely change the way you launch a satellite into space by essentially creating a ramp, like a tube that is 10 kilometers long, in which you are emptying, essentially taking the air off. So using the Hyperloop sort of method, if you want, using magnetic levitation to accelerate the launcher to about Mach 5, about 7,000 kilometers an hour, and oriented towards space. So it's using technologies that exist. And the CEO was the head of business development, if I recall, at Speed Launch. And so she had been involved in that sector for quite a while. At scale, you should be able to launch a satellite every 2 hours in space, essentially at a fraction of the cost of what a SpaceX can do. I mean, a fraction of the cost of a SpaceX. So it has significant implications for the space industry. It has significant implications for the defense industry because this is highly strategic. We invested at pre-seed. They're going to do a series the next year. We're adding more money now. I just love the tech. It's such a cool company.
Yeah.
So that's one. The other one is called Clay. Actually, oddly enough, this is our second company based in Los Angeles. It's in the music industry. Essentially, they're building a foundational model in the music industry. They just hired the former head of music tech at DeepMind. You know, the tech initially come from the MIT lab, and they just signed a pretty important agreement with Universal. And the angle here essentially is not working against, but with the music industry to be able to train the models and really creating a financial model for the music industries with products coming in the pipeline and so on. So there are two very early stage companies that we invested in over the last 12 months, and I think they're just very good businesses, right? And yeah, just give you an idea.
What about an anti-portfolio company, one that got away?
That got away or that went wrong?
The one that got away. So it's like the one you passed on or you missed yeah.
Yeah, I can't remember that. So we looked at the company in New York last year, and that's the one that comes to mind. And I felt it was very hard. It was AI related, and I thought it was very hard to build a moat. And when I'm looking at AI companies, back of my mind is how do you build a moat? Because this industry is moving so fast, and so much money going into it that I'm always worried that businesses will be irrelevant just in the next 12 months. So we looked at this company. Yeah. And I wasn't convinced about the moats. I had a bit of a reservation with regards to the founder himself. Anyways, they just had a big exit within 12 months. So we passed it 12 months ago, and they just had a big exit 2 months later. I'm like, okay, fine. It's so good.
That's funny. Yeah, but that's the space right now. Speaking of AI, what's more exciting for you right now, AI or space?
I mean, both sectors are very interesting. I mean, AI is I think it will change the way we live and we work. Like robotic, I think it will eventually, in ways that we just don't really comprehend so far. I think it's moving faster than we probably were used to, even in a fast-going, fast-paced environment. So I think AI is very interesting. As an investor, I'm very cautious, as I mentioned, but I think a lot of things are game-changing here. So I just can't wait to see where it's going.
Yeah, really exciting right now. That's one thing I look at when I'm looking at, you mentioned the moat. I'm thinking, okay, won't that just be a standard feature inside of AWS or Azure in the next 12 months? So one of the challenges. When I look at companies, I'm like, okay, great, you're building something, but is it a platform? Is it going to become this way of doing things? It's a hard thing. What's one book every founder should read?
So there is a book that I absolutely love from Michio Kaku. It's not very well known, I think, in Europe, but it's very well known, I think, in the US. Michio Kaku, he wrote a book called The Physics of the Future, probably about 10 years ago now. And I thought it was fascinating. And I offered it to many of my friends and investors. Actually, even offered it to the Prince of Monaco, believe it or not. I thought it was a fascinating book. And, I've been lecturing at university, as I mentioned, and it was on the reading list of my students. And although, a lot of what he was talking about in his book, some of it actually happened. I mean, he was talking about this very unknown company that was making some stride called Tesla at the time. There's a few things that I was reading about that actually did end up happening. So it's fascinating, to see how actually what he was talking about actually materialized. In his book, he was talking about some fundamental research that were going on that I'm actually now starting to see in startups. So it's a great book. I wish there was a completely updated version of it. But actually, this is a book that I read a couple of times, and I really recommend it to everybody.
Yeah, that's
Physics
great.
of the Future.
Well, it's been a pleasure having you on. Where can folks find you online?
People can find me on LinkedIn very easily, or my website, which is montecarlocap.com. So easy to find.
Yeah, thanks so much for coming on, Ian. Really appreciate it.
Thanks for having me.